Part 5 of your chapter notes for this unit is called the accounting cycle. It actually only covers this first initial part of the accounting cycle. My purpose with this video is just to highlight some of the important information, and we'll do a quick additional example together just so that I can clarify some points. First of all, remember that we said accounting events, accounting transactions or exchanges are the inputs into the accounting process. Those inputs get accumulated, categorized, sorted, and eventually formatted into financial statements, which are the output of the accounting process. It's useful to think about this process as a cycle of events that occurs in each and every accounting period for a company. Recall that accounting statements are prepared at least annually. So one of the things that you want to do anytime you're doing transaction analysis is make sure you're paying attention to what is this accounting period. This is from the chapter notes, and it's a summary of the steps that take place during the accounting period for a company. So let's say that the accounting period for a business is a year. During the year, every time a transaction or an economic event happens, the company will say, is that an accounting transaction? Is it more than a promise for a promise, basically? If the answer to that question is yes, then they'll classify, measure, and record the transaction. For this course, we will generally record transactions in accounting equation style. It's much simpler than doing journal entries and recording in T accounts, etc. That more formal process is also covered quickly in the course, but I really want you to be able to record transactions in the equation. A lot of additional work occurs at the end of the accounting period in order to accumulate and present that information correctly. This part of the accounting cycle will be covered in the next unit. Here's that accounting equation again. At the end of an accounting period, when you look at a balance sheet, the total assets will always equal the total of liabilities and equity because of the way we've defined these terms. There's a reminder of those definitions right above them. In order for that to happen, each and every transaction that we record also must balance across the equation. For example, if some economic transaction increases assets by $200, then we either need to increase liabilities or equity by $200, or we need to decrease another asset by $200. Each and every financial transaction that we record is going to balance across this equal sign. As long as each and every transaction that we record balances in the equation, the entire balance sheet will balance at the end of the accounting period. Before we do a quick example, here's another snip from your notes outline. And there's some really important process steps and hints in here. So first of all, up at the top here, you see the basic steps to follow in transaction analysis. First, you'll always want to ask yourself, is this an accounting transaction? Remember, you can have an important legal transaction or economic transaction that just doesn't qualify as an accounting transaction. It has to be more than a promise for a promise. For example, I can order furniture for my business. That's an example of a promise for a promise. Until I actually have ownership of that furniture, there's no accounting transaction to record. Or I can hire an employee, but until I either give that employee some money or that employee works for me, all we have is a promise for a promise. If the exchange does qualify as an accounting transaction, and again, that would be most transactions, then you need to record it. The steps are, first ask yourself what accounts are involved. Then ask yourself, should this account be getting larger or smaller? Then you record the transaction. Assign dollar amounts and record the transaction. We'll record the transactions very simply under A equals L plus E, and I recommend you always write that out. It's really simple and it's really easy and really frustrating to make careless mistakes when you're doing accounting. And a lot of times, a transaction you're recording now might depend on a transaction you recorded earlier. So it's very difficult actually to keep all of that in your mind. Just get in the habit of writing everything out. And then the real advantage of writing it out is that you can do step 5. Review your transaction to make sure it balances across the equation. Is the net increase or decrease under assets equal to the net increase or decrease under liabilities and equity? When you do transaction analysis, remember that your transactions are showing changes to these accounts. They're not showing ending balances in the accounts. To find out what ending balances in accounts are, you need to start with beginning balances in the accounts, adjust them for all of the transactions that happened during the accounting period, and then you will arrive at the ending balance in the account. And we'll see an example of that in a moment as well. The next thing you see here are some important hints, and we already talked about the first one here about writing things down. A couple of tips. Anytime you're doing transaction analysis, it's always a good idea to first ask yourself, is cash involved? It won't always be involved, but if it is involved, it's usually pretty easy to determine if cash ought to be going up or down. That makes it a lot easier to figure out how you're going to balance that in the overall transaction. Remember, most of all, as we do transaction analysis, that we're using the accrual method, not the cash method. Anytime you start to record revenue, ask yourself if you're recording revenue in the correct accounting period. Was that earned in this accounting period? Anytime you record an expense, ask yourself again if you're recording it in the correct accounting period. Finally, you should always make sure that you're using the rules of thumb that you've seen in the course notes. You'll find these rules of thumb at the end of the Cairo example. Here are the rules of thumb. These are rules of thumb for how we record original transactions. They're basically just default assumptions that we are going to use so that we're all following a standard approach and can get the same answers. The first rule of thumb helps you answer the question, if a company has incurred a cost, should that cost be recorded as an expense or should it be recorded as an asset? So you've got generally cash going out. How are you going to record the other side of that transaction, as an expense or as an asset? Just below that, you'll see another rule of thumb for determining how we record it when we receive assets in advance of performing services. We know we're going to increase assets should the other side of that transaction be a revenue or a liability. So read through those rules of thumb so that you can start to apply them consistently. Now let's do a quick example of transaction analysis. We'll be doing transaction analysis for tax services company, a little made-up business. As I said, you need to be aware of what the accounting period is for a company because that helps you apply those rules of thumb that I mentioned a little bit earlier. In this case, we'll be doing transaction analysis for a month-long accounting period, the month of January. So this one's super simple. Tax Services is a brand new corporation, and so beginning balances in all of the balance sheet accounts here are 0. Users of financial statements don't want to just know assets, total liabilities, and total equity. They need more detail. They want to know what kind of assets a company has, etc. So under each major category of type of account, we'll have various smaller categorizations called accounts. So very common account under assets would be cash. This is supplies. This would represent supplies sitting on the shelf, supplies that have not been used up yet. Accounts receivable, and I'll use a lot of abbreviations. If you ever see one in the course where you're not sure what I'm talking about, please let me know. Accounts receivable are amounts owed to a company from customers who generally received goods or services on credit. So these are accounts that the company expects to receive in the future. So they're an asset account. Under liabilities here, we have accounts payable. These are amounts that the company has to pay in the future. And under equity, we have the two standard accounts for corporations, that contributed capital account we've spoken about earlier, and the retained earnings account. The things that we'll record, remember what affects retained earnings? Net income and dividends. Net income is comprised of all of the revenue accounts minus all of the expense accounts. So what gets recorded in retained earnings is revenue, expenses, and then also dividends. Revenues increase retained earnings, expenses and dividends decrease retained earnings. So basically, this is just a slightly expanded version of the accounting equation. I've got assets, and the grand total of my assets at any time after recording a transaction will have to be equal to the sum of liabilities and equity. So down here in my little spreadsheet, this is a formula for total assets, this is a formula for total liabilities and equity, and after every transaction I can check and see down here if my entire accounting system is still in balance. Alright, well, let's do these transactions together. As I said, beginning of the year balances here are all zero. That is only because this is a brand new business. If this business had been in existence previously, we would have balances in all of these accounts. Balances at the end of the prior month would become the balances at the beginning of this month. Alright, our first transaction. The corporation, tax services company, issues stock in exchange for $10,000 from a shareholder. So a shareholder contributed $10,000 to the corporation in exchange for common stock. That's a type of contributed capital. What accounts are affected? Well, remember our rule of thumb. Was cash affected? Yes. Remember, we're doing accounting for the business, tax services company. Tax services company's cash increased. So here I've increased cash. Now we know we have to balance across the equation. I made this line coming down here a little bolder than the rest. That's my equal sign. So I want to make sure that my transaction balances across here. To do that, I either need another $10,000 decrease on the left or a $10,000 increase on the right. Well, this was basically a shareholder contributing capital to the corporation. So that amount goes into the contributed capital account. After I record that transaction, total assets equals total liabilities, and I can just eyeball it. This transaction balances across the equation. In the next transaction, the business goes out and buys $4,000 worth of office supplies, so a bunch of copy paper, toner, whatever they're going to need to do those tax services. This is where we have to rely on a rule of thumb. But before we do that, let's actually answer the first question that I tell you to think about. Was cash involved? Not in this case, because we see the magic words on account. Okay, that's the same as saying on credit. So tax services bought supplies on account. They bought supplies, but they haven't paid for them yet. That means that we would want to, as part of this transaction, instead of reducing cash, we're going to increase a liability account called accounts payable. As a result of this transaction, tax services owes somebody, Staples, whoever they bought these supplies from, $4,000. Now let's think about the other side of the transaction. Think about our definition. An asset is something that's going to provide benefit beyond the end of the current accounting period. An asset is something that benefits us in the future. An expense is something we've used up in this accounting period in the process of generating revenue. Well, what about this $4,000 of supplies? Initially, those supplies will be sitting on the shelf. They'd be an asset. But over the course of the month of January, we're likely going to be using some of them up. The business is going to use some of those supplies in order to run their business. It's very likely that by the end of January, much of the supplies will be used up, but some of the supplies will be still sitting on the shelf. We'll use the course rule of thumb. The rule of thumb for assets, when you incur a cost, and here we're incurring a cost. We haven't paid for it yet. There's a liability, but we're still incurring a cost. If there's a chance that the benefit of any of the cost will extend beyond the end of the accounting period, we set the whole amount up as an asset. And then we'll worry about figuring out how much of it should be an expense in the next step of the accounting cycle, the step where we do adjusting entries. So applying that rule of thumb, we set the whole $4,000 up as supplies, the asset. The alternative approach could have been to expense the entire $4,000, and then we would have had to correct that transaction in an adjusting entry as well. We'll take the simpler approach, or the more common approach at least, which is set the full amount up as an asset. Notice when we're done recording that transaction, which again balances across the equation, our total accounting system is still in balance as well. The next transaction that occurred is tax services paid $900 for January's rent. Was cash involved? Yes, in this case cash goes down $900. How do we record the other side of that transaction? Well, we have a cost. Usually it's either an asset or an expense. What can we record here? There's no liability being created. We're actually paying for January's rent in January. That $900 would be rent expense. Remember that expenses decrease equity. If you're not confident about the sign, remember that the accounting equation has to balance. So in order for this transaction to balance, and we feel good about the negative cash, you need a negative under retained earnings as well. Now, the entries that go into retained earnings eventually need to be organized into an income statement. So that we have the detail to prepare the income statement, I'm going to make a note here to the side that this is rent expense. Anytime you put an entry in retained earnings, you should note the type of revenue, the type of expense, or note that it's a dividend. Remember that dividends are not expenses. Dividends will not show up on the income statement. You will only see them in a statement of retained earnings. After recording the transaction, the system is still in balance. Take a look at the next entry. Our company provides tax advice for $2,000. $800 was collected and the rest was invoiced. So we did $2,000 worth of services, collected some of it, and billed the customer for the rest. Was cash involved? Yep, it says we got $800 of cash, so we can put that in right away. What else is involved? Well, we provided services of $2,000. Under the accrual method, we're going to recognize all $2,000 as revenue. We'll call it service revenue, even though we only collected $800 of it. Remember our definition of revenue: inflow of assets in exchange for providing goods and services. Well, what assets did we get? We got cash, and we got a promise. We got a promise from our customer that they're going to pay us the other $1,200 in the future. So accounts receivable would be $1,200. So here we have a total increase to assets of $2,000 and a total increase to equity of $2,000. Revenue also increased by $2,000. The system is still in balance. And finally, the last dividend, the corporation pays shareholders a dividend of $600. We have cash involved. Again, cash goes down $600, and dividends are a distribution of profits to shareholders, so they reduce retained earnings. At the end of the month, we have $9,300 in cash. Total in retained earnings is $500. We would report net income of $2,000 minus $900, $1,100, but we know that's incorrect because, as I said earlier, it's very likely that we use some of these supplies. Let's say that we'd used $3,000 of the supplies. In the next step of the accounting cycle, we would reduce the balance in this asset account by $3,000 and record $3,000 of supplies expense. And then at that point, if we didn't have any other adjusting entries to do, we would have correct information and be able to prepare our financial statements. You'll see all of that in Unit 2.